or thank you, Sheena. I want to know who's taking down deals right now. Anybody buying still?
Yeah, we just closed Monday on a place in Tennessee.
Ooh, another one. Gene, is it short-term rental?
Short-term rental. Yeah.
Nice. So how is Airbnb going in that area in Tennessee?
As
What was
far
it?
as like
Smoky something?
Smoky Mountains. Yeah. It's still right now we're booked up June, July, but they're booking out like more like 30 days out instead of 60 days out. So it's a little bit, they wait a little longer to book. So you kind of sit on your hands and adjust the prices and make sure your bookings are optimized. But we're taking less, like we had to lower the price just a little bit, because travel is kind of slowing down a little bit. But their annual numbers to that park is so big that, and the demand for, or the supply is not that high for Airbnbs. So I don't know, we'll see what happens, but we just closed on one, and Sherry and my sister go up next week to get it set up and ready to go.
Nice. And what was the rate on that? That was straight into a 30-year?
So this one, and this is where we're at now, is we had to go DSCR because the DTI is taking a hit. So DSCR, we went in at 8%. Yeah.
It's actually not bad,
Oh, is it?
It's not bad.
The numbers still penciled out pretty good because we were before all of this, we're shooting for 20+% cash on cash. This one we penciled out at about 17. So I mean, still, it worked out. So
yeah,
8%.
Okay.
I never thought I'd freaking see an 8% interest rate.
Yeah. And is that, I mean, are you guys cash flowing even with the 8%?
Yeah, we're cash flowing pretty good. Like I said, cash on cash. The first two did well. One was at 24%, one was at 20%. This is the third one. This one we pencil out at about 17% cash on cash. So the cash flow is actually still pretty good, but we don't know what's about to happen going forward.
Right. Yeah, our DSCR starts at 7, I believe, or 7.25 now. It's like 400 basis points from what we started in the beginning of the year. But I don't think we're really seeing any signs that it's going to turn around anytime soon. So, and in fact, I'll let Alex talk a little bit about some updates that we got on our MPLA call yesterday. But does anybody have anything they need? Any deals? Any funds? If not, then I'll let you go, Alex. You want to talk about MPLA?
Yes, sir. So yeah, we had a call yesterday on NPLA, and the guest speaker was a guy named Ryan. I didn't catch his last name, but he's with a company called Nomura. And Nomura is, one of the larger aggregators, and they do big securitizations. So like to even be an originator that works with them, you have to minimum dedicate 20 million a month to them. And that they don't work with anybody that's doing any volume less. So they're pretty big players. And so they have a 1,000 investor based platform. So they have 1,000, large investors and accredited and institutions that are buying their capital, and they're also doing the securitizations. They said there is a challenge from liquidity in the market right now in our space. On the back end, we're in a period right now of price discovery. And so essentially, I guess an easy way to look at that would be like, we're in a variable rate times right now. And you know, if you can get a rate lock with whatever company you may be working with, you know, that's great. And that might be something you want to look into. But at the same time, you just need to be prepared and aware that there's going to be an opportunity that rates do get adjusted throughout the course of your loan, especially if it's not a quick close. Let's see. So on the securitizations, they're trying to kick out a lot of paper right now. So like they rate it from a AA to a single A, and that is each loan individually that is a part of a securitization. They'll have a company come in and actually rate this pool. So right now they're really like the pools that are getting sold are pools that have A and AA. So it's, you know, lower LTVs, great borrowers, you know, just solid loans, all performing. And so like the higher leverage stuff, like kind of like we do, this 90% stuff is, you know, stuff that's not getting sold in securitizations at this time. They're, you know, kicking that out. So groups are having to hold paper longer. Right now, we talked about a smaller pool of buyers right now in the space, and as of like right now, there are people, you know, that are exiting, and there's a lot of people that have stopped lending because they're stuck with a whole bunch of paper that they wrote and they don't have anyone to buy it, or their source stopped buying, and then they're trying to sell that paper that maybe that higher leverage stuff, and the buyers aren't there for it. Kevin, you got a question?
Oh no,
Okay.
I'm good.
But we also talked about how securitizations, like the paper essentially right now coming like on is going to be at like 9 to 10% is what's coming soon. And essentially what that means is like that's going to be the cost of paper to the bigger aggregators. So it's just going to trickle down. So rates are, you know, I would say it's not going to be uncommon probably to see bridge rates, like, you know, even top tier borrowers get up to 11-12% potentially. It may not happen, you know, right away, but he also said that like we're literally Leonard asked for an analogy. You know, he says, I'm a baseball guy, you know, like give it to me, and like where are we at? And actually no, it was John Hornick said that, and he said he's a baseball guy, and he says, well, if I was gonna, you know, say where we're at in the game, he said, I would say, you know, we're just about to have the first pitch. So like we're really just going into the recession that's on the way. But he's thinking the forecast is 12 to 18 months. There's probably going to be another rate increase in July from the Fed. They're thinking it's going to be, you know, 75 basis points. And then they think another one's going to come in December at 0.5 point. So that's when all those happen. Obviously, it's going to trickle down and affect, you know, our space and, you know, conventional, especially the DSCR loans. His best advice was take a look at fixed expense and be very mindful. Raise liquidity right now. So if you have the opportunity, now is the time to raise capital, you know, because there's going to be opportunities. And then just make sure you're buying good, and you're watching all of your expenses and your overhead and your business right now. Let's see. I guess lumber's up 37%, and freight is also up 37%. The average build time for an SFR went from 100 days to 200 days now. So, you know, your holding times, cost is a lot longer. 10% of homes right now are being built for rent nowadays. Or in 2008, in that area, when the last crash happened, for that decade, it was about 10% of homes were built to rent. Nowadays, it's 30%. 30% of SFRs being built are to rent. Right now, the most amount of homes ever being built in construction is going on right now. And at the same time, the lowest amount of completed homes are available on the market at this time as well. So pretty interesting stats, but I think really for us just to be aware of is the rates are going to increase. And so just really be mindful of that and, prepare, and your business model is just to forecast for, higher rates. And, it's especially when you're getting into a DSCR deal. For you, Gene, it works great, right? Because you're doing short-term rentals. So your cash flow is just, so much higher. But if you're in a property and like say someone that was trying here doing the Airbnb, and now they're going to have to go to, a long-term, anyone that's buying now, it has to be long-term, right? They're not going to be able to do that short-term cash flow unless it's in the zoned right. So it's going to be really hard to, I feel like, qualify properties for DSCR loans here with the higher rates, especially if they keep increasing, because I think we're starting at like 7. So if we're gonna have to start at 9 soon, that's gonna eliminate a lot of opportunity for that product. But yeah, that I think, and they predict that the recession's not really gonna start until fourth quarter of this year.
Party's just getting started.
Yeah.
Yeah, that's pretty crazy though, because there's a lot of action already in some markets moving pretty quick and not in the right direction. So thanks for taking notes during that one, bro, and updating us all. And Alex was made a point where on the call, they made a point to say that, now's the time to stay liquid a little, right? And so I think that's a key point. The guys who are still here who weathered different pullbacks and recessions in the housing market, I think since they've been through it a couple of times, they know when to start preparing. And when it comes to staying liquid, it's like, how do we balance that? Because we know that money likes to move. Money, it doesn't like to stay stagnant, right? And it only deteriorates when you keep it in one place, especially a bank account. So how do we keep moving money when the market is not moving in our favor? How do we be on the right side of this? Well, yeah, again, like what we mentioned, I think a couple calls ago, is you can do this in any market, especially if you're house flipping. If it's short term, if you're house flipping, then you can do this in any market, in any market cycle. You just have to change your criteria, right? So like what Alex is saying is expect longer holding times because there's less people who can afford to buy a house now because the cost of capital has gone up substantially. So that's going to shrink the buyer pool. That's going to give buyers less leverage or sellers less leverage. And it already starting to slow some markets down. So how do we prepare? Well, we prepare by exactly what they were saying on MPLA, is that you got to stay liquid. One is to make sure that you have enough runway in case your business is impacted by anything. Maybe it's the war, maybe it's the supply chain issues, maybe it's the capital markets kind of losing liquidity. Whatever it is, we want to try to stay ahead of it, and staying liquid is a hedge. It helps you hedge against running out of money, right? So you want to keep some reserves. So I know for us, we've been on capital raise binge, and we were talking about the costs of sitting on the sidelines, right? And some people think that that's safer, which in some cases that could be true. And everyone's circumstance is different. So you have to kind of be in charge of your own destiny and make those decisions on your own. But for the most part, I think we forget that sitting on the sidelines is risky too, because we're running out of time. And it doesn't happen overnight, right? Real estate is not a get rich quick venture. It's definitely not. It's long-term legacy is what it is. So knowing that, we have to make decisions, the best decisions that we can now, like a few months ahead of time, especially in times like these. So for us, we've been out there kind of raising capital and trying to stay ready just in case, because I will pay high interest on, a lot of money to hold that money in the likely chance that there's going to be big opportunities very soon. So if there aren't any, then even better, because I don't want our market to go down. I don't want us to go into a deep recession. That's never fun. So, but if it does turn, then we'll be ready for opportunity. If it doesn't, even better. And the worst that's happened is we've paid to hold that capital that we'll likely have to return if we don't use it. But to me, that it'll probably be less of a loss paying high interest on a large amount of money than to miss out on once in a lifetime opportunities that may or may not happen soon, if the market does correct. It doesn't happen many times, right? So a lot of people are waiting to sit on the sidelines when the market goes down, but the real players are still in the game. In fact, they're playing harder than ever, so that's what I was saying. Like, I've never been through a housing recession, and we may not see one here. But like, I want to be ready, so whether it's mentors or people who have been doing this a lot longer than I have, maybe they haven't done as much, but they've been in the game longer and they've felt the waves and the cycles of the market. I can learn a lot from that, and I have been, right? So we're going to be prepared and we're going to be ready on the right side of this either way. So what I'd encourage you guys is, yes, let's start talking about what we do so that we can get people interested and maybe have them invest with you and start raising some private capital like right now. Like, we need to start raising right now. If we're looking to start, the party towards the end of the year, then we need to start right now, positioning ourselves, right? Maybe looking at strategies, looking at new markets. So one thing for us is we're looking at different avenues. Wholesaling, because we're going to be starting up a wholesale arm, and specifically just in Hawaii. We'll be looking at the NPL market, the non-performing loan market, specifically in the private lending space, and this will be like nationwide. We're going to be looking at markets that are prime for cash flow and appreciation, so that we can identify nice markets that we can go in and start doing some bird deals in select markets, right? So, and I say this all with the intention of working alongside everybody here on the call. That's my hope. Because man, I don't know if Alex is still on, but we're reading this book, Go Giver, Sell More. It's like the same guys that wrote the Go Giver. They did a whole series, and Alex recommended it as our next book for the book club that we're doing for our company. And it's such a good book. Oh man, I didn't think you could beat the first one, but I think it's getting there, because I've been trying to explain my style of selling, I guess, if you want to call it selling. And because it's not really traditional sales theory. So reading that book has reminded me, one of the concepts in it is talking about your personal economy, like, which I refer to it as your social capital, right? So the teachings in the book is saying that it doesn't matter what market conditions you are playing in, whether it's a boom time or a bust time. It doesn't matter. In fact, what matters is your social capital, or your social sphere, because there will be opportunities whether the market's going up or down, because you've surrounded yourself in your own little bubble, your own little social economic bubble, right? So the relationships we have and the networks that we have will help sustain us through any turn in business is the basic fundamental premise of that. And I think I was even on Steve's podcast, Steve Rosenberg, like years ago, maybe like 3 or 4 years ago, talking about social capital. And I think I have a clip out there somewhere, but I was talking about how, Keiko and we would have discussions. This is early on when we were first starting. And, we're talking about how if we lost everything today, all of our resources, all of our, private capital or deal flow, that we'd be fine. We'd just fine. Like, I'm not even worried about it, because our network, which is all of us on this call here, right, is so strong that I feel that there would be opportunities. There would be someone who we've helped, hopefully along the way, that would come by, pick us up, dust us off, and put us on their shoulders and let's go. Let's rock and roll. Let's get back to it. So just know that calls like this is important because it gives us security, and it's a lot more fun in my opinion, but gives us security. And we know that we have a group of people that we can lean on in case, we need help. So moving forward, we're raising a lot of capital, and we may not even deploy. I have no idea. It might just cost us. But again, if you look, as a real estate investor, you have to look at many things, and one of them being you have to be looking ahead to be ready for opportunity, right? And if it doesn't come, that's fine. It's good. That means the market's doing well, and we're gonna keep going. So, but let's be proactive, So, does anybody have any thing that they've noticed in their area or market, things slowing down? We're talking about this last week, but I think it's good to ask this question every week because things can change quick. Ben, how is Washington? Is it even more so 7 days later?
It's pretty much the same, really. I mean, still, slowing down a little bit, some price reductions, some things sitting, but also things that are, kind of top of the segment are selling quickly. So it just sort of depends on the condition of the property, the neighborhood and all that. But yeah, definitely slower than it was still, but not a whole lot changed since last week.
Nice. Okay. And then are you seeing neighborhood specific too? Like some neighborhoods are still on fire, or
yeah. I mean, the best neighborhoods and the best houses in certain neighborhoods are always, still selling quickly. Still, multiple offers, but probably not 15, 20 offers, probably, 3 to 5, and still going over asking in some cases, but definitely a lot less of that.
Yeah. Okay. That's the Northwest. Is anybody on the East Coast? Or is doing deals on the East Coast? Let's see. Quick scan.
I can speak to Hawaii while you scan the room.
Yeah, please.
It's interesting the perspective on the agent side of things when they're getting counter offers in a situation where my agents will call me right now and they're like, we're still getting a counter stating that we need to waive J1 or that we need to waive certain contingencies. And the response now is no. Like, there's no other offers, or there's only one other offer, or we can strengthen the contracts in other ways, but we're not doing that anymore. However, they're still going above asking. So I see a small shift there, obviously neighborhood specific. So some neighborhoods are hotter than others naturally. The condos, it's kind of interesting. And I don't know if this is like this nationwide, but here, like the larger the complex, it seems, the condo market doesn't shift too drastically unless if you get a really good deal as a fixer-upper. They don't have major swings. And so they were selling though during this time where people were just so desperate for housing, they were going into condo complex that typically would sit for 100, 200 plus days. And now just in the last month, we're seeing those sit again. And they're very specific, and I'm sure every market has their own. But we did get a message today from some of the one of the lenders we work with that the rates went back down. So VA interest rates went back down into the 4% and conventional into the 5%, which Chris, I'm sure, can speak on too. So that is going to help, any of the people who are on the fence who are kind of waiting for interest rates. That's something that you can leverage right now, I think.
It's actually really great info when you hear, they're countering you guys. So counter with about the contingencies or financing or whatever it is. And then now the buyers know that they have leverage now, right? Because they're saying no.
Yeah, and that's something we're talking.
That's actually a huge, yeah.
It's normal. So now it's like people are still trying to act as if, or play the part as if the market is still there. And with some houses it is. You're not going to walk away from an opportunity if it doesn't matter to the client. But yeah, just shifting that mindset of all of the people who came into the market in the last 2 years, they have a very skewed perception. And how many agents out there who are representing the investors or who are bringing the buyers to the, us investors, how many of those just came into the business in the last 2 years? So it's going to take some time just correcting sellers' mindsets and stuff moving forward. But I think it's going to be an important shift. I mean, we were literally giving up like our children to get offers accepted. Like, please, here, I promise, here's a promissory note for my next child. Like, I'll wash your car for a year. It was weird. It got weird.
Well, let's see. Chris, do you have any updates on anything new or?
Yeah, I got up this morning and I checked the 10-year treasury bond and it's dipped below 3%. Now it's like at 2.88, which is great. Interest rates are coming down, and then they have, I think the next Fed meeting is July 15th. And so sometimes that happens where like the market will come down a little bit before the meeting. It's been happening for like the last year or so, and then who knows after that meeting if they'll make that adjustment in rates. And so it's hard to predict, it was great this morning when I saw that. But the market's closed today because of the holiday on the 4th.
That's
Yeah, that's right.
So I was like trying to lock so many loans today, and then our lock desk said, "Oh, it's closed today." I'm like, "You would be closed today."
Hey, how often do the feds meet? Is that like a specific time every month or every quarter, or is it just
it's quarterly, and so it's been random, of course, these past couple of years with COVID, and that's changed some things. But I think the next meeting is like the middle in 2 weeks actually. So we'll kind of wait and see what happens.
Yeah. Well, I know that the DSCR market is pretty much gone. Like nobody's really doing DSCR loans, and even if they want to go for one, it's hard to make the numbers work unless like Gene with his property that's short-term vacation rental, which typically has higher cash flows, that can qualify for a 30-year. Once you start getting to like the 500,000 range, the DSCRs start to get a little hard to make. The higher the loan amount, the harder it is to clear cash flow, right? So, well, I guess one thing I wanted
Hey Corey.
Yeah, Keone.
I had a story, brother. I wanted to share. Now that I know that Ashley's on, it's pretty interesting, but it's probably a lesson for a lot of us investors out there. And this is agent specific, neighborhood specific. I think what Ashley just said. What I'm getting towards is that at one of my properties, renovation we came out of, we put it on market. We got multiple offers, and then we accepted, I guess one that fit the bill. We went into escrow, and then we already started getting feelings that it probably wasn't going to work out. So we had backup offers, and then the option that Ashley was my representative. She's always on the sales side for me. So our conversation was, hey, do we want to try and entertain these backup offers that we had, or should we put it on the market and open up that buyer pool? And in this span, this was just like within 1 week, not even 2 weeks, interest rates started shifting. So there was these things that were happening. And anyways, we made the decision, you know what, rather than playing around with these guys that we had on the sideline as far as backup offers, let's put it out on the market, back on the open market, and see what happens. So we did. We got tons of interest. But here's the lesson, is that we had an agent, and Ashley shared this with me, it was so hilarious, now that looking back at it, but nevertheless, it's their due diligence, and they're listening to the market, but this is in Waianae, in the west side of Oahu, and we were at a certain price point where we're already below, where market is, just to open up the buyer pool, but they were super confident. Their clients loved the property. And then they shared with Ashley saying that, oh my God, we want this property. Tell your sellers we want it. We're going to make an offer. And then Ashley was like, cool. And then she said, and just to let you know how serious we are, we're going to come in at asking. And then she said, I'm sorry, what? So again, we're in this cycle where like we're getting all offers all over asking. And I know it's shifting, and we're in some type of correction and whatnot, but for the mindset of an agent telling her clients, yeah, we're going to get this because we're going to come in at asking. That's just how dangerous this is, right? So it's like, it's just so crazy. And the funny thing is, like, she's hyping everything up, but then saying like, we're going to come in at asking. Like, wait a minute, we got tons of offers all over asking. So suffice to say, right, she just said, you know what, if you're just going to come in at asking, just save your pen, save your time, because it's not going to work out. We already got offers 50,000 over asking still in this market. So again, it's very key on who your representatives are, the selling side, and who's representing you. It's just weird that, with people hearing interest rates and all these changes, it's kind of dangerous to me, like, with these agents out there that not really know what they're doing and basically are in their mindset saying like, oh yeah, it's coming down, right? It's a buyer's market, so we control the narrative. Hawaii specific, it's still inventory low, right? We're very low on inventory. And again, it's very neighborhood specific. Share that story that, we closed almost 100 over asking on this one. So we just closed today, but yeah, wanted to share that story.
Congrats, bro.
Congratulations. And to Keone's point, when we first went under contract, it was one of those nice, like, slingers where when we came out, we came back under contract higher than the one we were first under contract with. But he's right. We hear that a lot. I've actually heard that since we went under contract with Keone's again, heard it on another property. And originally the buyer that Keone's referring to wanted to come in below asking. And then I talked to her and she's like, you know what? I got them at asking. So I'm going to draft this up for you. Let's get this done. I was like, or don't.
Well, I mean, that is kind of, I think they're just a little early to to take that posture, but I mean, props to them for trying, right? We've all been on the other side of that. So but I think the important thing that Keone was saying, which I agree with wholeheartedly, is like when things change, and that saying, it's almost cliche, but actually it is cliche to say when the market turns and stuff, it's like, oh, who's going to still be around, right? It's all the guys with the experience and this and that. And like, it is true. It's true, but it's true because of what Keone is talking about. The high performers will make it. There's people who just have success and greatness just instilled in them from birth, and then there's others like myself who kind of got to pay attention and learn and actually consciously try to learn and follow. And, so, and that's, I think, is the majority of people. And when there's a disruption, like let's say, yeah, there is a big correction, then the people who will still be doing business are the guys who would be successful anyways. It's the realtors who take the time to take temperature calls, like pick up the phone, call the other side, get a feel for them, pay attention to the details like that. You know, like those are the people who win the bids. We would get our offer accepted over others, even though it's not the highest offer, time after time and again, you know, and to a point where people were saying, like, where are you guys getting your deals? You know, and we're like, oh, it kind of got down on market, got down on market. It's like, wow, it kind of got a lot on market, you know, and I started to realize, because I had to, like, what's the difference, right? Like, why do we get our offers accepted? I didn't even know, you know, there wasn't any relationship there where there's any like fishy business going on. Like, we were bidding just like everybody else, but the difference was the team representing us, which is Ashley and her team, they pay attention to the details. You know, they don't just submit an offer for their client, pick up the phone, call the other side and sell. That's your agent's job, is to sell for you. There's, you know, it's a sales position. Whether they're selling the house or they're selling your client, that they should be selling, you know. So don't just accept, especially now, if things start to turn and you know, like, it's going to be harder and harder to make the numbers work. You're going to have to adjust your criteria. You're going to need someone very strong to, you know, representing you and negotiating for you and speaking on your behalf. So like I think sometimes realtors, they get overlooked in our industry. Like they're some of their, like their value. If they're going to be part of your power team, then you kind of have to treat them as if, you know, they're anyone else within your company, right? Because when they're out there negotiating for you and submitting offers, they're representing you too. So hopefully they have the same moral compass, and they do business the same way that you do. But more importantly, that they're high performers, so that when times get hard, because it has been hard recently, right? It's been hard on the buy side. It's been a strong seller's market. So the people who are getting into deals on market are the people who they know how to negotiate and pay attention to the details. So we want to make sure that we are high performers, for one, and then we hold everybody around us accountable who are along with us and signed on the line to join this journey. Like they are striving to be or aspiring to be high performers and leaders as well, because those are the guys who make it through whatever market cycle, you know, and there's no secret to it. So that is an interesting point to hear, that it looks like it's shifting a little. And the main takeaway, which is gold, that Keone just gave, which it may just go over some of our heads here, is that you want to make sure that you're working with the real deal, right? The high performers, the people who are going to get you into contracts and they're going to sell your house quick. I don't mess with the discount agents anymore. You know, I learned my lesson multiple times in that space, and you can see real clear, because there's not many of them around anymore doing the flat fee, you know, because that shit doesn't work. People need to be paid what they're worth. So
we saw a flat fee guy come back into the market. I thought he was done for a while. And I know a lot of investors used to work with him back in the day, like even 5 years ago, even like a year or two before COVID happened. They were still predominant. And I mean, it was just a very interesting what an agent on my team was submitting an offer on one of the listings. And it was a generic, I'm all about systems and templates, but it was a very generic template of like, we'll get back to you with that question within 24, 48 hours. But it was like, do you have any offers? You know, something really simple. And so just the overall process of getting a quick response is all of that's going to lose the momentum and the excitement of the buyers. And it's all in the details. But I started seeing more and more of their listings pop up again. And I think it'll be really fascinating as we do pivot into a market that is going to require work, you know, to get listings sold again. The iPhone pics with you in the in the bathroom mirror is not going to work anymore. Coming soon. So it'll be really interesting to see who's standing, you know, in next year and the year after. But on your flips too, pressing market, like running your ARVs right now, like I'm always really conservative on ARVs. I've always like, sometimes my investors have larger numbers than I do. And I'm like, gosh, I hope I'm not like a deal killer or something, because I'm too conservative. And I think it's going to be safe to say if your project's going to take, more than 30 or 60 days to be ultra conservative, just simply because you don't know if, keep in mind, if it's in a flood zone, for example. Corey was just asking me at dinner. Yes, we always talk about deals all the time. And he's like, so what would an ARV be on this house in Kaava? He's kind of going over this, and it's like, well, there's a massive difference. It can be hundreds of thousands of dollar difference if it's in a flood zone. Right now, and on Keone's deal, that was actually one of the factors, is it was in a flood zone because it was on the Mackay side of Farrington. And we didn't have to think about that for the last year or two. That honestly, like, it's something that you just kind of, everyone just took it. They just were like, whatever, give it to me, I'll pay it. Now they're putting that back into consideration. That's back on the table, being like, ooh, 300 extra a month on flood. I don't want to go above asking as much as I did before. Like, or I'll pay asking, but I'm not going to go above if it has that. So just keeping all those little details in mind moving forward. As investors, you guys buy cash, you don't have to pay attention maybe as much to the flood premiums, depending if you're doing hard or private.
Well, if you're flipping it, well, regardless, you still always should check flood, because like that property Ashley's talking about in Kaava, it's an AE flood, which is it's one of the highest that you get, right? Except for AEF. Joel was stuck in the AEF, which you talked about before. That's a floodway. That one's brutal, but AE is still, you're in flood and your insurance premiums are going to be expensive. So, which probably means that it might make it harder it's going to shrink your buyer pool on the back end. Where people can't just, the guys who are just gonna get by and they can afford it, like just afford it and qualify, that those are gonna wipe out those buyers from qualifying to buy the house, is the insurance. So you will have a smaller buyer pool. So how do we adjust for that criteria? Well, I would say that you have to look maybe like half a year in the future. So maybe I'd take 5 to 10% off of my ARV. So whatever the comps that are showing right now, I might take off 5 to 10%, maybe not 10. That might be a little drastic right now, but 5%, and possibly add another couple months on the holding time, maybe 2 to 3 months, maybe another quarter, just to be conservative.
Yeah. And when you're doing the takedown too, like ask if they have a flood elevation certificate, or see if, now that the market's shifting for you guys too on the investing takedown side, try to negotiate that in with your survey, or at least the cost of it, because the amount of surveyors, there's only a couple now that do flood elevation certificates. And that 10 years ago, there was a lot more. So the cost for that went up exponentially. And if you have a flood elevation certificate, you provide that to the insurance, get your quotes in advance from the insurance companies and provide that in the MLS with the supplement documents, or give it to the agent prior to submitting the offer, so that there's no in escrow surprises. So you make sure when you're talking to the lender, are they accounting for the flood premium? Make sure everyone's comfortable with it in advance. I think that's key. And how we closed Keone's successfully was because we went through and we decided to go back on market, because we went through and I got the flood insurance premiums and I went to every single buyer. And if they sounded a little shaky whatsoever, it was a no-go, even though they were 50,000 or plus above asking price or more. So we waited until we had a buyer who's like, I don't care. And that's the one that we went with. So try to negotiate what you can now on the back end. On the front end.
Let me just interject as well and just add this. And like Corey, you had talked about, discount, agent, flat fees. The key is you get what you pay for. Look at all these nuggets that Ashley just dropped, as far as agents and investors. These are gems that we wouldn't know what to do with, right? As far as like the flood side, but like there's a lot of things that she just said that when these things happen, these agents got to understand how to pivot, how to still make the deal work, how to negotiate. Everything that she just said, these are key components on having a high performer, what you just mentioned as far as a representative. So definitely giving you your flowers, Ashley, because these are big things that could have just killed deals. And it does kill deals, but you know, like with you and being super savvy on your end, it's like that's how we're able to just keep moving forward, you know, and just keep shit rolling. So thank you.
Appreciate it. Thank you. Mucho. I mean, Keone was really cool too. Should we say what happened to the house in escrow or no?
Oh.
Okay.
Oh.
So something that I'm gonna try to talk to my investor clients on the vacant houses, especially in certain neighborhoods, is after you're done with the reno, crime across the US has gone up quite a bit, especially, you know, Hawaii is no different. There always was in certain geographic spots, but now more than ever before. And we got broken into while we were under contract. And it's happened before, you know, but this one was a little bit bigger of the termite inspector came. He's like, Ashley, is there supposed to be like a lockbox on the gate? And I was like, yeah. He's like, I think only the handle's here. And I was like, well, there's supposed to be something.
Keone was saying that?
No, the termite inspector.
Oh.
This guy was so gangster. He was so cool. He still went in and did the termite inspection, even though he's like, wait, is there supposed to be a washer and dryer in the back? There's some copper pipes just like sawed off. And I was like, yeah, there is.
What? They took the washer dryer?
They took the washer dryer, and the guy still went inside. He did his termite inspection. He was super cool. He sent me some pictures. They rummaged through the whole house and they stole just thousands of dollars of staging. It was, and of course the stagers I use the really nice stuff. So like a throw pillow is way too expensive, like a couple $100 for a throw pillow. The sheets are like the boho, get it from the local lady, probably $300. I was like, oh my God, it's 4-bedroom house. I staged every bedroom. I was like, oh God.
They took all of it?
They took all of the bedding, the carpet, the pillows. I mean, obviously they took the things that were something important to them for housing. So they took the washer and dryer to wash all of the bedding and the shit they stole. And they kept the super nice like furniture, the big pieces, probably because they can't fit it in their tent. Anyways, it was a bummer. And I was like, I already know stagers because I've had stuff stolen in the past. I know I cover it. Like, I'm not gonna, stagers can't typically afford that. And it's not their, I don't know. I feel like it's a gray area, but anyways, I'm just like, tell me how much it is. I'll cover it. Still super duper stinks. Luckily they didn't take the big stuff, but call Keone, and there's a lot of different reactions that can happen in that. And luckily I'm calm. He was very calm. He's like, okay, well, we strategized. Do we put the washer and dryer back in right away or do we wait? And so we waited. We were thinking about, well, let's wait because the next buyer, since we were in also the process of falling out of contract and we were just accepting the next buyer, we just accepted their offer. And we wanted to see if they were going to do their home inspection. Long story short, we're like, do we put it in before the appraisal and the home inspection? Do we leave it out so it doesn't get stolen again? Because it's a vacant house off of Barrington Highway. And we're like, oh, okay, well, Keone just made the executive decision, replaced it that week. So it was there for the home inspection, and then installed a camera that had the solar panels. So it had a floodlight camera. I was like, put a floodlight camera facing the road, the gate. So that way, if anyone walks up to it, the light turns on. You get a notification. It'll help alleviate that problem. It helped. No one broke in since, and we secured it. So my 2 lessons learned was, one, I forget to ask investors, can you put up, I know it's a couple $100 or a few $100, but monitor your property, monitor your stuff. It doesn't hurt when the contractors are there anyways. You can keep an eye on the contractors, make sure they're showing up to the job, make sure people, you know, or if they're stealing their products, you have it there. Layla, you know, sacrificed her sanity, putting one on your guys' project in Makaha before. And she got all of the pings, but it helps smooth. And for us on the back end, we're investing and we're taking on the risk on the listing side, on the back end with that furniture. And I talked to an insurance guy and I was like, I need to find a solution to this problem because this has happened too many times. How can I secure and protect the staging? I want an insurance policy. I'll get one for my company if I can do that. But I don't want to do the staging. I looked at the numbers. It doesn't make sense. I looked at it like a billion times, a lot of work, little profit.
It sounds to me that should be their responsibility, right? Like,
You would think, but it specifically says, and I read through all my staging contract, it specifically says if anything's missing, damaged, or anything, it's the agent's responsibility. The agent can't get insurance on it because it's not the agent's inventory, it's not their product. And the homeowner doesn't want to provide insurance on it because it's not their product.
Yeah.
But staging in Hawaii is so expensive. We don't have big target companies like IKEA's and stuff. So getting good quality materials here is too expensive, and storage is too expensive here. Movers is too expensive here. So the profit margins on staging is so small. And on the
Oh,
mainland,
really? Are you
realtors-
killing my staging dreams
I know.
right now?
right?
So are you
Thank you,
telling me?
Ashley. Thank you. I've been telling him.
I've been looking at it. So many stagers have offered to sell me their inventory, and I've been blessed by a couple of them, like sitting down and going over the numbers. And I was like, no, girl, I get why you're dissolving. It just is not profitable. And it's an entire business model because you got to coordinate the movers, and then the projects always get delayed. And then the realtors are just, some of us are just mean. They're like, oh yeah, I'm just moving it to Thursday, make it happen. Otherwise you're fired. And you're like, no, everyone's booked. Like, it doesn't work that way. So anyways, I talked to the stagers about getting insurance policies, and it's not profitable. And on the mainland, the sellers pay for staging typically, not the agents. In Hawaii, I mean, back when I started, nobody was really staging. And then that's how I won a lot of people over, was I was doing it. So I was only making like 30% of my income, but I was getting a majority of the business. But now there's a lot more people staging, paying the stagers, and there's still not enough profit margins. Otherwise, the staging is going to be like $6,000 to stage a Waianae house, and that's just not going to make sense. So if anyone has a solution or can create a loan product, Corey, what you could do is create a loan product that could be insured that people can pull out for furniture.
I'm pretty sure our partners are not going to care about this insuring the stagers inventory. I mean, it's probably low priority.
I need a solution. Help
Well,
me. There's lots of money in the room here.
What I want to find out, because I don't know, is can we count staging as hard costs for our investors? Because if it's hard costs, then we can have it into have them put it in their budgets, so then they can buy their own staging, just throw it in a part of the project, write it off, and then we all start our own staging company, a Keiko staging company. It'll be a nonprofit, and then everybody just put their inventory. We'll buy a storage center, and then we'll take up like maybe a few of the storages, and we'll lease everything out. I think that's a good plan.
Because sourcing products and assembling them.
Well, actually, the economics probably aren't going to work. You're right.
Takes
You
forever.
pay like $4,000 for staging, $4,000 to $6,000 on average for staging. You figure that inventory is being tied up for like maybe 2 to 4 months, right? And like if you're leasing it, we can't lease it. That's gonna be way too expensive. Yeah, I don't think it's gonna work, guys. As Mr. O'Leary would say, take it behind the barn and shoot it. We're done here.
So the lesson though is put video cameras, solar powered cameras, $300 on Amazon. Order it part of your costs. Throw one on each side of the property. Have an app. Has a little siren and alarm if something happens. You can hold contractors accountable.
Yeah, that's actually been a game changer. Except I don't have the app, so I can't log. I just gotta get updates from Laylogs. But Ring System is worth it. We got broken into 5 times. I think it was 5 times in Vegas. Same house, and all they did was break in and urinate in a couple of the bedrooms. And like, why? It's like, why? So not only now do you have to disclose that, right? But now like there is a target. I think there was 2 different people, and we got broken into 5 times, and then we put all the security in place. In fact, our realtor who was selling it for us in Vegas, it would alarm her. So somebody broke in at like 3 a.m, and then her husband, Tiffany's husband, picked up the phone and started yelling at the guy, and you could see him on camera running, just because I guess you can communicate through voice, right? So in times of recession too, it gets worse, so like this tip is going to become more and more relevant. I feel, if there is a correction, but again, I feel we're in a different state than we were before. And Ashley was kind of the first one to speak sense into it, where, the average credit score today, I believe, is 755, for people who got mortgages. Whereas back in 08-ish, the average was right below 7, I think, like 699 or something like that. People have more equity in their houses now, so they have more resources to sustain any recession. But no matter what, when there's a recession, things move, like slow down. Life changes. So, but it is my hope that it won't change or slow down for any of us on the call, because we take the time to build genuine, long-lasting friendships and relationships here, that we would step up to the plate if we were called on to help someone that we've met along our journey in this game. So that is something that we can all move forward with the security, knowing that we got good people behind us, and that if you're ever in trouble, reach out. Don't be shy, don't be ashamed. Like we're all kind of wondering where this is going to go to, right? And it doesn't matter what level you're playing at. I mean, we're seeing it every day. Every day I'm getting a new list, or we're hearing of new lenders who are no longer lending. Some are out of business. Some have closed their doors temporarily. Some have loans on the table that they're trying to sell to us. Like I literally have to get off the line to get on a bunch of these calls, because some of our friends, who are their friends now, are stuck. They cannot sell their notes. And if they can't sell their notes, then they will go bankrupt. It's just a matter of time. And it happens quick. We've seen it in COVID. So this is a second round that we're seeing it. And this one isn't as sharp as a drop. When COVID happened, the financial markets just went way upside down. It only bled into our space as the real estate investor. We only were impacted like real temporarily. But what most people don't know is in the financial markets and the private lending side, there was a lot of people who did not make it through that, and some big companies too. And the big aggregators who have all the money and that everyone's just selling to, couple of them have now, which means there's less liquidity in the market, substantially less, because these guys were doing billions per month, so that's a lot of money that's not going to be flowing anymore. So rates will go up, even on the bridge loans. They already have, and leverages may go down. They have gone down from some of our colleagues. They have to adjust their leverages because they're selling to the buyers on Wall Street, and so are we, but where our capital structure is a little different. So this is actually going to be opportunity for us. And lastly, before we jump off the call, I did have a need I was going to throw out there. And I just want to put out there that if you guys know of any hard money lending companies or any lenders who are stuck with loans, or they have had to pause their lending, or maybe left you at the table, or you think that there's a lot of things going on with their company, there's a lot of disruption, then can you please let me know? Because we are active, like this is opportunity for us. So one, it's opportunity to help these guys. Maybe we can help them. And two is in helping them, we'll make a lot of money too. It'll help us out a lot. So if you guys know of any lenders that you've heard of that are no longer in business or can't lend, they have to pause, or they're having major problems at the closing table, let us know. All right, guys, does anybody have anything else before we wrap up and go celebrate 4th of July? All right.
One thing, Jack's Pizza in Haleiwa is for sale. It's not listed, but it is, the business itself is for sale. The lease is in place and is negotiable. It's a very easy space to negotiate. Prime location, right in Haleiwa Plaza 2, right by Long's and American Savings Bank. And they have a negotiation with outdoor seating, but it is.
Is it a franchise?
No, Jack's Pizza. It's one of my clients, and now she's one of my agents. Pizza shop. Her son is his name's Jackson. So they named it Jack's Pizza. It's a fire brick oven pizza business, already established, really good customer base. So if you guys know anybody who wants to take over that business or who really likes pizza and feels like it would be a good thing to add to their repertoire, then send me a message. And Chris, I don't know if he's still on, but he has a commercial loan now product. So I don't know how that would work with you guys at Keiko, but I'm sure you guys, anybody who has anything over 4 units, but below 8 units, I just wanted to put that out there that Chris and Corey can help with that now through Pacific Bay, which I thought was really cool.
Yes, ma'am. We are here.
Thanks, Ashley. I'm driving right now, so I'm like coordinating directions. And yeah, Pac Bay just announced they now land on the commercial side, 5 to 8 units. And yeah, I'm still getting all the details, and I've got pretty much most of them that I want to get. I want to fine tune everything and make sure I know all just everything. But it's exciting.
Yes, sir. It's good to have you here, Chris. Chris is moving in, so if any stagers trying to liquidate their furniture, and maybe Chris is interested. I don't know.
I've been like on like Marketplace, and I stopped by a storage unit in like right next to the office, and the lady, she buys like a lot of staging, furniture and stuff, and then she sells it. So I wanted to tell Ashley about that since we're talking about that. So after the call, I'll text you, Ashley, and I'll give her number. But it's like, I looked in there. I don't know if it's stuff that can be used because it's just kind of outdated and just been sitting there. So I don't know if it's valuable, if they're useful. But yeah,
Maybe
I
worth
went to
checking
the
out,
warehouse.
right?
It was huge. Yeah.
Awesome. Well, right on, guys. I hope you guys all have a great Friday. Happy 4th of July. We'll see you guys next week. Aloha, everybody.
Aloha. Happy 4th.
Happy 4th.